Hi there. I'm Old Man Explainer, because sometimes you just want things explained by an old man. Today, I'm going to talk about the infamous GameStop short squeeze of 2021. Let's get to it. We'll cover it in 4 parts. Just what really happened, why did it happen, who really benefited from this, and so what happens now? Just what really happened. Okay, so first we need to talk about the necessary background information. What happened is called a short squeeze, so let's talk a bit about how that works. Trading stocks has become mostly a derivatives market by the power players. While mutual fund managers and individual investors will often buy and hold stocks that they like, hedge fund managers tend to use derivatives more often than not. These are instruments that are created by brokers to allow for alternate positions on the market. One of those instruments is called a stock short. To accomplish a stock short, an investor pays a fee to a broker in order to borrow a bunch of shares and then give them back at some point in the future. This can actually be done with very little of your own money. What happens is that you get, say, 1,000 shares today, and then in 10 days, you have to give the same number of shares back. Why would you want to do that, you ask? Well, you'd only really do that if you thought that the value of the shares was going to go down before you have to give them back. This is one way to make money on a market that is going down, and you don't even have to have enough money to buy all of the shares that you borrowed in the first place. Big investment firms exploit this by borrowing millions of shares, selling them immediately, and then using the proceeds to buy them back again before the contract ends. So, let's say that I saw what was going on in the GameStop scenario. When the stock hit $347.51 per share on January 27th, I could have opened a short position on GameStop with 10,000 shares and a return date of February 5th, today. I would have borrowed stocks worth $3,475,100 and sold them at that price, keeping that cash in my account. Now, today I have to cover that position, which means that I have to buy 10,000 shares at today's market rate, which is about $53.50 per share. Still many times what it was just a few weeks ago, but much, much less than what I sold at. So, I spend $535,000 to buy the shares and give them back to the broker, hanging on to the $2,940,100 difference, minus the fee that I paid to the broker to set up the short position. Despite the possibly morally bankrupt position that would have put me in, I kind of wish I'd done that, don't you? If this is legal and it's so lucrative, why doesn't everyone do this all the time, you ask? Well, it is legal, though perhaps it ought not be. But it's usually not so straightforward, and it's not normal for stocks to change value so much in so short a period of time. And that brings us to the next question. Why did it happen? Well, let's find out. So, to answer why it happened, one must first look at the business position that GameStop finds themselves in. They are a largely brick-and-mortar business that makes money from selling retail copies of video games and the hardware and peripherals used to play them. In recent years, the trend has been for gamers to go into stores much less, and the pandemic has made that even more true than the already existing natural trend. Internet access is available at higher speeds and lower costs than ever before, so unless I have to pay in cash, or I just really want to have a physical token of my purchase for a video game, it is much simpler to just use my credit card and buy a digital-only copy that I can download in minutes over a gig-speed connection. All of this has combined to make GameStop's business very unlikely to succeed in the long term. But holiday sales showed a bit more strength than expected, and at the end of last year and the beginning of this year, the stock price for GameStop was up to about $20 a share, which is not very high, but higher than its previous position at about $10 a share. The past few years of pressure on their business model has created a small gap in the current market price and what the hedge fund managers expected it would be once the holiday sales were over. And seeing that, coupled with the effect of the pandemic, they saw what was an easy bet to make. And if you listen to the folks on Wall Street, that should have been the end of it. The hedge fund managers borrowed millions of shares at the 20-ish price point and sold them, expecting it to fall shortly to the 10-ish market again. They would then buy back all their millions of shares and turn them over to the brokers and basically double their money. But some folks on a Reddit subreddit called Wall Street Bets noticed this and decided to try a short squeeze. They marshaled as many people as they could find, and they started buying up as much stock as they could. This caused the price of the stock to rise, as demand created by their purchases, plus the demand created by the need for the hedge funds to cover their positions, caused the stock price to rocket up to the point that it hit. The different fund managers had to compete with each other to buy the remaining shares in order to cover their bets, and it was that competition between the fund managers that really caused the spike in the price. If these positions had not been opened and coming due, the buying that the Wall Street Bets group did would not have been nearly enough to drive the price of the stock to the heights that it hit. However, the price is now dropping back towards the levels that the business can actually sustain, and that is hurting a lot of those people who bought the stock on its way up, thinking that a large group of small players could hold on and keep driving it up forever. Sadly, once the hedge fund managers had purchased the stock they needed to cover their positions, the largest part of the process that was driving up the stock price was removed. It seems very likely at this point that all of those original short positions have been covered, and the new volatility in the stock is attracting other types of speculation that is keeping it propped up at around the $50 per share range now. But largely, this leaves the Wall Street Bets group holding the bag. Who really benefited from this? It might be easier to answer that question by starting with the question of who really got hurt by this. Some of those big hedge funds that the Wall Street Bets group were targeting with their squeeze got hurt badly. Melvin Capital, in particular, lost as much as 53% of its total value during the short squeeze. However, they are a hedge fund, and they are supported by other Wall Street firms with loans, and they will be just fine. Altogether, the short squeeze was responsible for erasing some $70 billion in holdings from Melvin and other firms like it. It was a big hit, and it will take them a long time to recover from it. The popular trading app Robinhood is also implicated in a lot of what went on, being that a large percentage of the individual investors who bought shares of GameStop to prop it up used that app to do so, until the company stopped allowing users to buy shares of GameStop right at the height of the event. Whether or not this was a good decision in terms of protecting their business from exposure to market losses is probably a more complicated question than I can answer here, but I do know one thing for certain. The move alienated their customer base in a huge way. There are hundreds, if not thousands, of customers of Robinhood who are now hanging on to stocks that they spend a great deal more to buy than they are currently worth. The trickle-down effects of this are likely to be felt by the company for a long time if they survive at all. So, who did benefit? Surely someone must have. And yes, there are many individuals, the more savvy of the group that started the squeeze and who sold before the stock started to really drop off completely. They made money. Some of them made millions. However, while they were selling off their positions, they were telling others to continue to hold, using ride or die sorts of memes and language as a means of propping the value of the stock as much as they could, despite the fact that once the short positions of the big players were covered, there was simply not enough buying power in that group to keep things going as they were. Today, there are hundreds, if not thousands, of individual investors who are holding on to shares that they acquired at a cost basis of between $150 and $350 a share, and the current share value sits at about $50 a share, and is unlikely to ever get that high again. These people will be desperate to get their money back, and eventually they are going to realize that they need to sell their shares for the $50 share price they can get now, or the $20 share price they will likely be able to get in 6 weeks, because that was money they could not really afford to lose. There are people who are telling them to keep holding, that the company will turn around, and that especially if they go and spend money in GameStop stores, that the company will one day be worth as much as they paid for it and they can get their money back. In this old man's opinion, this is nothing more than a ploy by the people in the market who are going to be opening new short positions based on these new conditions. I have no doubt at all that many public figures with large wallets and many other hedge funds are doing this right now. So, there will be more winners yet in the GameStop fiasco, but it is not going to be the little guys who are now holding underwater stocks. It will be the hedge funds that decide to bet against all of those little guys who will not be able to hold on to the stock forever because they were betting money they could not afford to lose. So, what happens now? This was a really high-profile event, and it may be a catalyst to bring about some reform of the markets, but I really doubt it. This was an event that affected thousands of people, so there will be a lot of pain to spread around, and a little bit of wonder for those who managed to benefit from it by selling at the right time or by knowing how to play the market better than most of the people who are being hurt. But really, that hurt is going to drag our already failing economy into deeper lows, while the Wall Street firms continue to profit by exploiting the losses of that large group of people. Think of it this way. If you were caught up in this and added your money to the pot, there are a few people who are lucky enough or selfish enough to pull most of that money out, and they are riding the highs right now, while everyone else is left to look at the pot and wish there was still enough in it to pay them what they put in. Most of the money is going to go to Wall Street. Most of the people who were pulled in are going to lose almost everything, or they're going to have to wait decades to see if GameStop can manage to survive and thrive. Is it possible? Sure. If all the people who bought stock start spending a lot more of their money into buying products from GameStop, then maybe the company will succeed in the long run, and the price of their stock will naturally climb to the level it was purchased at. But that would require years and years, and the sort of attention that the market has never really shown to be possible. Even a loved brand will die when the market moves away from it. Just ask anyone who shopped at Blockbuster. If you like this video, subscribe or let me know in the comments below, and I might do more of them. You can also suggest things that you might want to have an old man explain.